Warren Buffett's empire, and the Gen Re insurance fraud scandal. In the pantheon of American business legends, few names command as much reverence as Warren Edward Buffett, the Oracle of Omaha. For decades, this folksy billionaire has been portrayed as the antithesis of Wall Street excess, a man who shuns derivatives, preaches long-term value investing, and operates from a modest office in Nebraska while building one of the most successful investment empires in history. Berkshire Hathaway, his sprawling conglomerate, has delivered average annual gains of over 20% for 4 decades, making Buffett not just wealthy beyond measure, but a moral authority on corporate governance and ethical business practices. His annual shareholder letters are treated like scripture by investors worldwide, filled with homespun wisdom about integrity, transparency, and the importance of owning businesses you can understand. Yet, between 2000 and 2005, this paragon of corporate virtue found his empire entangled in one of the most sophisticated accounting fraud schemes of the era, a scandal that would reveal how even the most respected institutions can become complicit in deception when the stakes are high enough and the relationships run deep enough. The scandal centered on Reinsurance Corporation, known as Gen Re, one of the world's largest reinsurance companies, and a crown jewel in Buffett's insurance empire. Berkshire Hathaway had acquired Gen Re in 1998 for $22 billion, the largest acquisition in the company's history at that time. Reinsurance is a complex but crucial business. It's essentially insurance for insurance companies, allowing primary insurers to spread their risk by purchasing coverage from reinsurers like Gen Re. This industry operates on relationships, trust, and sophisticated financial engineering, making it particularly susceptible to manipulation by those who understand its intricacies. Gen Re was led by Ronald Ferguson, a respected industry veteran who had built the company into a powerhouse, and later by Joseph Brandon, who would oversee much of the period in question. The company's Hartford, Connecticut headquarters housed some of the brightest minds in risk assessment and financial structuring, expertise that would prove valuable not just for legitimate business purposes, but for creating the complex transactions that would later land several executives in federal prison. The fraud itself was breathtaking in its audacity and sophistication, involving a series of fake reinsurance transactions designed to help American International Group, the insurance giant known as AIG, manipulate its financial statements. Between 2000 and 2005, Gen Re entered into sham transactions with AIG that were structured to look like legitimate reinsurance deals, but were actually nothing more than elaborate accounting tricks designed to boost AIG's reserves and smooth its earnings. The centerpiece was a transaction codenamed CAPCO, executed in 2000 and 2001, which involved Gen Re providing AIG with $750 million in what appeared to be reinsurance coverage. In reality, no risk was actually transferred from AIG to Gen Re. Instead, AIG paid premiums to Gen Re, and then immediately received most of that money back through various side agreements and circular payments. The net effect was that AIG could book the transaction as an increase in its loss reserves, making its financial position appear stronger to investors and regulators, while Gen Re collected fees for facilitating what amounted to an accounting charade. The mastermind behind much of this scheme was Maurice Hank Greenberg, AIG's legendary chief executive, who had built the company from a modest insurer into a global powerhouse worth over $100 billion. Greenberg was notorious for his iron-fisted control over AIG's operations and his obsession with meeting quarterly earnings expectations, traits that created enormous pressure within the organization to find creative ways to manage financial results. He worked closely with AIG's chief financial officer, Howard Smith, and other senior executives to identify reinsurance partners willing to participate in these artificial transactions. The relationship between AIG and Gen Re ran deep. The companies had done legitimate business together for years, and their executives moved in the same circles within the tight-knit reinsurance industry. This familiarity bred the trust necessary to execute increasingly complex and questionable deals, with each successful transaction emboldening the participants to push the boundaries even further. Phone records and emails later obtained by investigators would reveal how casually these executives discussed transactions that they knew were designed primarily for accounting manipulation rather than legitimate risk transfer. Genry's participation in these schemes was orchestrated by several key executives, most notably Christopher Garand, the company's assistant general counsel, and Elizabeth Monrad, a senior vice president who specialized in structured transactions. These weren't rogue employees operating in the shadows. They were respected executives working at the direction of senior management and with the apparent blessing of the corporate hierarchy. Internal Genry documents would later show that executives were well aware they were helping AIG achieve specific accounting objectives rather than conducting genuine insurance business. In one particularly damning email, Garand wrote about ensuring that a transaction would produce the right accounting result for AIG, language that prosecutors would later use to demonstrate the fraudulent intent behind these deals. The executives involved weren't naive about the implications of their actions. They were sophisticated professionals who understood both the technical aspects of reinsurance and the accounting rules they were helping to circumvent. The unraveling began in 2004 when New York Attorney General Eliot Spitzer, then at the height of his crusade against corporate corruption, launched an investigation into bid rigging and other improper practices in the insurance industry. Spitzer's aggressive approach to white-collar crime had already claimed scalps on Wall Street, and he turned his attention to the cozy relationships and questionable practices that seemed endemic in the insurance business. The investigation initially focused on bid rigging schemes involving other companies, but investigators soon uncovered evidence of the more serious accounting fraud involving AIG and Genry. Federal prosecutors and the Securities and Exchange Commission joined the investigation, bringing vast resources to bear on unraveling what they suspected was a multi-billion-dollar fraud spanning multiple years and involving some of the most respected names in American business. The investigation would ultimately involve hundreds of thousands of documents, dozens of witnesses, and forensic accounting analysis that traced money flows through dozens of corporate entities and offshore subsidiaries. As the investigation intensified, the human drama began to unfold in ways that would have seemed impossible just years earlier. Hank Greenberg, the imperious AIG chief executive who had seemed untouchable for decades, was forced to resign in March 2005 amid mounting legal pressure and a rebellion by his own board of directors. His departure sent shockwaves through the insurance industry and Wall Street more broadly. Greenberg had been a titan of American business, and his fall demonstrated that no one was immune from the post-Enron crackdown on corporate fraud. At Genry, executives began lawyering up as it became clear that the company's participation in the AIG transactions was a central focus of the investigation. The FBI executed search warrants at Genry's Hartford headquarters, carting away boxes of documents and computer hard drives in scenes that were broadcast on financial news networks around the world. For a company that had operated in relative obscurity despite its size and importance, the sudden media attention was jarring and deeply damaging to its reputation. Warren Buffett himself found his reputation under unprecedented scrutiny as details of Genry's involvement became public. The man who had preached corporate governance and ethical behavior for decades was forced to explain how his company had become entangled in such a massive fraud. Buffett's initial response was to express shock and disappointment, claiming that he had been unaware of the fraudulent transactions and that they violated everything Berkshire Hathaway stood for. In his 2005 shareholder letter, he wrote extensively about the scandal, acknowledging that Genry employees had engaged in abhorrent behavior and promising to cooperate fully with investigators. He announced that Berkshire would take a $460 million charge related to the scandal and would strengthen its compliance procedures to prevent similar problems in the future. However, critics questioned how such sophisticated and extensive fraudulent activity could have occurred at a Berkshire subsidiary without the parent company's knowledge, particularly given Buffett's reputation as a hands-on manager who prided himself on understanding his businesses intimately. The legal consequences of the scandal were severe and far-reaching, ultimately resulting in multiple criminal convictions and hundreds of millions of dollars in fines and settlements. In March 2008, Christopher Garand, Elizabeth Monrad, and two other Genry executives were convicted on federal charges including conspiracy, securities fraud, and mail fraud related to their participation in the AIG scheme. Garand was sentenced to 4 years in federal prison, while Monrad received a 2-year sentence. AIG ultimately paid $1.6 billion to settle civil charges with regulators, one of the largest settlements in SEC history at that time. Gen Re itself paid a $50 million fine and entered into a deferred prosecution agreement that required the company to cooperate with ongoing investigations and implement extensive compliance reforms. The scandal also contributed to broader regulatory changes in the insurance industry, including stricter oversight of reinsurance transactions and enhanced requirements for risk transfer in insurance contracts. The Gen Re scandal represents a fascinating case study in how corporate culture, personal relationships, and competitive pressures can combine to create conditions ripe for fraud, even within organizations led by individuals with sterling reputations for integrity. The transactions at the heart of the scandal weren't the work of a few rogue employees. They required coordination across multiple levels of two major corporations and involved some of the industry's most sophisticated professionals. The fact that these deals continued for years suggests a normalization of deviance, a gradual erosion of ethical boundaries that allowed increasingly questionable behavior to be rationalized as standard business practice. For Warren Buffett and Berkshire Hathaway, the scandal represented a profound challenge to carefully cultivated images of ethical leadership and superior corporate governance. While Buffett's personal reputation ultimately survived largely intact, the incident served as a reminder that even the most respected business leaders are not immune to the systemic pressures that drive corporate misconduct. The complexity of modern financial instruments and corporate structures means that fraud can occur deep within organizations in ways that may not be immediately apparent to even engaged senior management. The broader implications of the Gen Re scandal extend far beyond the specific criminal convictions and financial penalties imposed on the participants. The case highlighted fundamental weaknesses in the regulation and oversight of the insurance industry, particularly in the area of reinsurance, where complex transactions can be structured in ways that obscure their true economic substance. It also demonstrated how the pressure to meet quarterly earnings expectations can create powerful incentives for financial manipulation, even within companies known for their conservative management and long-term orientation. The scandal contributed to a broader loss of faith in corporate America that had begun with Enron and WorldCom and continued through various other accounting fraud cases of the early 2000s. For individual investors who had looked to Warren Buffett as a beacon of integrity in an increasingly corrupt corporate landscape, the Gen Re scandal was particularly disillusioning, suggesting that even the most trusted business leaders could be associated with serious misconduct. The case serves as a lasting reminder that in the complex world of modern finance, the line between aggressive accounting and outright fraud can be perilously thin, and that maintaining ethical standards requires constant vigilance at every level of an organization.